Most retirees in America are voluntarily handing over tens of thousands of dollars to the IRS every single year. They do this because they fell for a massive misconception. Everyone tells you that if you want tax-free income in retirement, you absolutely must have a Roth account. That is just not true. If you are rushing into aggressive Roth conversions right now, you might be walking straight into a trap. With the Tax Cuts and Jobs Act provisions heading toward a major shift, making hasty moves can easily push you into a much higher tax bracket today for a benefit you might not even need tomorrow. There is an alternative framework hiding in plain sight within the current tax code. By stacking 3 specific tools that you likely already have access to, you can potentially generate a 6-figure annual income completely free of federal income tax. No Roth conversions required, no extra management fees, no complicated paperwork. If you do not know how to coordinate these tools, you are leaving your money exposed. You risk triggering state-level tax traps and unexpectedly spiking your Medicare premiums. We are going to break down exactly how this framework operates so you can take control of your cash flow. Let us start with the first line of defense. Most people treat the standard deduction as a boring footnote on their tax return. That is a mistake. It is actually your first and most powerful tax shield. For a married couple filing jointly, the standard deduction provides a massive baseline of zero tax income. If you or your spouse are age 65 or older, the IRS tax on an additional deduction bump for each person. When you add those numbers together, you get a substantial buffer of completely tax-free space. This creates what we call an empty tax bracket. Your goal every December should be to intentionally fill this gap. You do this by withdrawing money from your traditional 401k or traditional IRA up to that exact threshold. When you pull money from a traditional retirement account, the IRS normally treats it as ordinary income. But because you are matching that withdrawal perfectly with your standard deduction, the tax rate on that specific chunk of money drops to 0%. You are effectively converting traditional pre-tax money into tax-free cash without paying a dime for the privilege. Many traditional financial advisors tell you to defer your traditional IRA distributions as long as possible. They want you to wait until you are forced to take required minimum distributions. That advice is often flawed. If you leave your standard deduction completely empty during your early retirement years, you are permanently wasting a 0% tax opportunity that disappears on December 31st. You can never get that blank space back. This zero tax shield is highly time-sensitive. If Congress allows the current tax provisions to expire or change, this standard deduction baseline could contract significantly. That means your window to exploit this large 0% gap is open right now, but it is not guaranteed forever. An open standard deduction shield is a solid foundation, but it only covers a fraction of a typical retirement lifestyle. To scale your tax-free income past the $100,000 mark, you need to look at the second tool. This is where most people miss a massive gold mine sitting inside their regular, taxable brokerage accounts. The federal tax code offers a special 0% tax bracket specifically for long-term capital gains. For a married couple filing jointly, the threshold for this 0% rate is remarkably generous. You can have a substantial amount of taxable income and still qualify for a 0% federal tax rate on your investment growth. When you combine this 0% capital gains bracket with your standard deduction, the math becomes incredible. A retired couple can potentially realize a 6-figure total cash flow from their investments while paying 0 federal tax on the gains. To make this work, you use a technique called tax gain harvesting. Most investors have heard of tax loss harvesting, which means selling losing investments to offset gains. Tax gain harvesting is the exact opposite. You intentionally sell your winning stocks or funds while your income is low enough to qualify for the 0% capital gains rate. The moment after you sell, you buy those same investments right back. This immediately resets your cost basis to the current higher market price. Why does this matter? Because you have just wiped out all the future tax liability on that growth. If the stock continues to rise and you sell it years later, You only pay tax on the growth from this new higher starting point. You might wonder if this violates the IRS wash sale rule. It does not. The wash sale rule is designed to prevent people from manufacturing fake losses. The IRS restricts you from buying back a stock within 30 days if you sold it at a loss. But the IRS has no such rule for profits. They are perfectly happy to let you realize a gain today, even if the tax rate on that gain happens to be 0%. You do have to watch out for internal tax traps within your investments. If you hold traditional active mutual funds in a regular brokerage account, the fund managers often trade stocks inside the fund throughout the year. At the end of the year, they pass those capital gains distributions down to you. You get hit with a tax bill even if you did not sell a single share of the fund yourself. To prevent this, successful investors often ditch active mutual funds in favor of passive index ETFs. Passive ETFs use a unique mechanism that minimizes these internal distributions. This keeps you in absolute control of when you realize gains and when you do not. Mastering your brokerage account allows you to unlock enormous sums of money without paying the tax collector. But your retirement income is not just made up of investments. For the vast majority of Americans, the core foundation of their monthly cash flow is Social Security. And Social Security has a very strange, highly misunderstood relationship with the IRS. Social Security income actually possesses a built-in tax exemption mechanism. The IRS never taxes 100% of your Social Security benefits. At most, they can only touch up to 85% of it, leaving at least 15% completely tax-free for everyone. But if you play your cards right, you can push that taxed percentage all the way down to 0. To determine how much of your benefit is taxable, the IRS uses a formula called provisional income. Your provisional income is calculated by taking your adjusted gross income, adding any tax-exempt interest you received, and then adding exactly 50% of your Social Security benefits. The problem is that the thresholds for taxing Social Security are incredibly outdated. The base thresholds for married couples were set decades ago and have never been adjusted for inflation. Because of this structural lag, more than half of all seniors now pay income tax on their benefits. You can beat this system by managing what enters your adjusted gross income. When you withdraw money from a regular taxable brokerage account, the IRS does not look at the total amount of cash you pulled out. They only care about the profit margin. If you sell $50,000 worth of stock and $30,000 of that was your original investment, only $20,000 counts as a capital gain. Only that $20,000 enters your adjusted gross income calculation. The $30,000 of original principal is completely invisible to the provisional income formula. By sourcing your retirement spending from a mix of original investment principal and 0% capital gains, you keep your provisional income below the federal thresholds. This effectively shields your entire Social Security check from federal taxation. You are turning a benefit that is usually taxed into pure, untaxed cash flow. When you understand how these three tools operate independently, they look like neat financial tricks. But the real magic happens when you stop looking at them as separate silos and start stacking them on top of each other. This creates a powerful unified income engine. Let us look at how this works in the real world with a practical scenario for the year 26. Consider a retired couple, John and Mary, both over the age of 65. They need a total annual cash flow of $115,000 to cover their living expenses, travel, and health care. They do not own a single Roth account. Instead, they have a traditional IRA, a regular taxable brokerage account, and their Social Security benefits. First, they collect $40,000 in combined annual Social Security benefits. Next, they look at their traditional IRA. Knowing that their combined standard deduction for 26 protects roughly $33,600 of ordinary income, they withdraw exactly that amount from the IRA. Because this withdrawal perfectly matches their standard deduction shield, their taxable ordinary income sits at exactly 0. To bridge the remaining gap and hit their $115,000 spending goal, John and Mary turn to their taxable brokerage account. They need another $41,400. They select specific investments to sell. Of that total payout, $20,000 represents the original principal they invested years ago, and $21,400 is long-term capital gains. Now look at how the IRS views this entire puzzle on their tax return. The $20,000 of returned principal is completely non-taxable. The $33,600 from the traditional IRA is entirely offset by the standard deduction. Because their adjusted gross income is kept exceptionally low, their provisional income stays safely below the decades-old federal threshold. This means their $40,000 of Social Security is completely shielded from federal tax. Finally, look at the $21,400 in capital gains. Since their overall taxable income is virtually non-existent, these gains fall squarely within the federal 0% long-term capital gains tax bracket. When you add up the cash deposited into their bank account, John and Mary have exactly $115,000 to spend. When you add up their total federal income tax liability, the final number is exactly $0. They did not have to pay a conversion fee. They did not have to wait 5 years to access their money under complex Roth rules, and they did not violate a single line of the tax code. Executing a strategy like this requires precise, down-to-the-dollar execution every November and December. If you accidentally pull out just a few $1,000s too much from your traditional IRA, you can trigger a steep domino effect. That extraordinary income can instantly push your capital gains out of the 0% bracket and simultaneously expose your Social Security benefits to taxation. Even if you execute this strategy perfectly at the federal level, you cannot afford to celebrate just yet. The federal tax code is only half the battle. Many retirees plan their entire income strategy based on federal guidelines, only to get blindsided by state-level tax traps that can completely derail their cash flow. The reality is that America's tax map is deeply fragmented. 11 states, including major hubs like California and New York, refuse to play by the federal rules when it comes to investments. They do not recognize a preferential 0% tax rate for long-term capital gains. If you harvest a gain in California, the state treats that profit exactly like ordinary salary, hitting you with state income tax rates that can climb well into the double digits. The variance is just as brutal when it comes to retirement benefits. While the federal government uses the provisional income formula to determine if your Social Security is taxed, states have completely independent rules. A handful of states still levy their own independent taxes on your Social Security checks, completely ignoring the fact that you might have navigated the federal system perfectly. If you live in a state with aggressive income tax rules, you have to adjust your stacking order. For example, a resident of a high-tax state might need to prioritize pulling more principal from a brokerage account rather than harvesting capital gains. Or they might need to utilize specific in-state municipal bonds to keep their state-adjusted gross income artificially suppressed. Taxes are not just a current cash flow problem either. The way you structure your income today sets the stage for how your wealth will be transferred tomorrow. Many people spend their entire lives hoarding money inside traditional Tree accounts or aggressively funding Roth accounts, believing they are leaving the cleanest possible legacy for their children. But your regular taxable brokerage account holds a massive, hidden structural advantage for estate planning that often blows the Roth IRA completely out of the water. This advantage is a rule known as the step-up in basis. When you hold assets in a regular brokerage account and pass away, the original cost basis of those investments is completely erased. If you bought a stock 40 years ago for $10, and it is worth $100 on the day you die, your children do not inherit your $10 starting point. Their new cost basis automatically steps up to $100. If your children decide to sell that stock the very next week, their taxable capital gain is zero. Decades of compounding growth and massive appreciation are wiped completely clean of tax liability in a single moment. Now compare that to what happens with the inherited Roth IRA under current legislative frameworks like the Secure Act. If you leave a Roth IRA to a non-spouse beneficiary, such as your children, the IRS imposes a strict 10-year clock. Your children are legally required to liquidate that entire account and pull out every single dollar before the 10th anniversary of your death. While the withdrawals from an inherited Roth IRA are technically tax-free, forcing your children to empty a massive account within a tight 10-year window strips that money of its long-term compounding power. Furthermore, if they inherit traditional pre-tax retirement accounts instead, being forced to empty them in 10 years often hits them during the peak earning years of their own careers, slamming them into the highest tax brackets possible. The taxable brokerage account avoids this forced liquidation trap entirely. Your heirs receive the stepped-up basis immediately, and they can choose to leave that money invested to grow for another 30 or 40 years without any government-mandated withdrawal schedules. It offers an unparalleled level of flexibility across generations. This fundamental shift in estate dynamics is driving a quiet revolution in how wealthy families position their assets. The old playbook said you must maximize your tax-sheltered accounts at all costs. The new playbook recognizes that overfunding restrictive retirement accounts can actually create a massive financial bottleneck for your heirs. By maintaining a robust, highly liquid taxable brokerage account, you grant yourself total lifestyle flexibility today, while gifting your children a clean, tax-optimized inheritance tomorrow. The absolute freedom of this strategy is what makes it so compelling. When your wealth is locked inside a traditional IRA or a 401k, you are entirely at the mercy of the federal government's rules. They tell you when you can touch the money without a penalty. They tell you exactly how much you must take out every year once you hit your mid-70s through required minimum distributions. If you need a large chunk of cash to buy a motorhome or pay for an emergency medical procedure, pulling that money out of a traditional account can instantly catapult you into a crushing 32 or 35% tax bracket. A taxable brokerage account, paired with stacked strategies, removes that government leverage. You become the manager of your own tax brackets. If you need an extra $50,000 in a given year, you can strategically harvest that cash from your investment principal, leaving your ordinary income completely untouched, your Social Security safe from taxation, and your federal tax bill at zero. Many people spend their entire careers chasing the next hot investment trend or stressing over fractional percentage points in mutual fund performance. They fail to realize that tax drag is often the single biggest destroyer of wealth in retirement. You can have the most brilliant investment portfolio in the world, but if you lose 25 or 30% of your distributions to an uncoordinated tax strategy, you are drastically cutting your portfolio's survival rate. The three-part framework we broke down today is not an exploit or a sketchy loophole. It is the literal design of the tax code, put in place by legislators who expected people to use it. The problem is that the system is incredibly fragmented, and the rules do not talk to each other automatically. The standard deduction does not care about your Social Security thresholds. The capital gains brackets do not automatically adjust to protect your IRA distributions. The burden of synchronization rests entirely on your shoulders. So what is the biggest secret to achieving true tax immunity in retirement? It is not a special type of account with a fancy name. It is not an expensive financial product sold to you by an insurance agent. It is your willingness to sit down every autumn, map out your income streams, and master the intersection of the standard deduction, the 0% capital gains line, and your provisional income limits. You can build a synthetic, high-performing Roth alternative out of a regular investment account without ever paying a conversion fee. Take a close look at your financial landscape as you look ahead. Look at your tax returns from the past couple of years. Are you leaving your standard deduction completely empty while letting your traditional pre-tax balances balloon into an RMD time bomb? Are you holding active mutual funds that are triggering phantom capital gains taxes that you could easily avoid by switching to efficient index ETFs? Do not wait until April to figure this out. By the time you sit down to fill out your tax software or meet with your accountant in the spring, the window of opportunity for that tax year is slammed shut. Every single move, every sale of stock, and every retirement account distribution must be finalized before the clock strikes midnight on December 31st. Take control of your distribution sequence, protect your hard-earned assets from unnecessary taxation, and make sure you are the one dictating terms to the IRS.